Welcome back to the Open Web Forum at CogX, curated by Fabric Ventures. Solar noon has passed, and so it's provided us with some slight relief in air temperature, but for our panels, the heat never stops. So to moderate a discussion on crypto and macro investing, we have our Fabric family's newest research partner, Tom Walton-Pocock. Tom was co-founder and CEO of Aztec Network, a premier developer of Ethereum-based snarks. He is also one of Cointelegraph's top 100 people in crypto for 2021. So over to you, Tom.
Thanks for the intro, Ian. So welcome to the Crypto Macro Investing panel. I'm very excited today that we have two of the most luminous commentators on macro and investing more widely, but specifically and lately on crypto. So the first of those is Raoul. He initially rose to prominence as a hedge fund manager. He famously ran the Goldman Sachs hedge fund sales business in equities and equity derivatives in Europe. Notionally, he retired at 36, but he is CEO and founder of Real Vision, which is a financial media company known to many of us, which offers in-depth video interviews, research publications, and studies the thinking of the world's best investors. So welcome, Raoul.
Great to be here, Tom.
And I certainly came to know the name of Lynn Alden Schwartzer through your platform. Lynn originally was an engineer, also a financial specialist as well. And she provides investment research for retail and institutional clients through her website, lynnalden.com. She tends to emphasize fundamental research with global macro overlays. And she appears not just regularly on Real Vision, but on many channels, including the Wall Street Journal, Market Watch, and CNBC. So welcome, Lynn.
Hey, thanks for having me. Happy to be here.
Likewise. So I've seen you both face off on Real Vision before. And I want to kind of run this mostly as a kind of discussion really between the two of you. And I'll sort of help sort of guide us through the various topics I'm keen to cover today. And first of those is obviously where it all began, so Bitcoin. First question really to you, Raoul, is this the first credible store of value candidate that we've had arguably since the Bronze Age? And to what extent has the current parlous state of central bank balance sheets how much was that the sort of the required activation energy to bring this new asset class into the position it's now in?
Yeah, I think if we think about the store of value argument, obviously we left the gold standard a while ago, and we've been using that, and then it moved to this fiat standard, and the fiat standard was okay if you didn't have monetary largesse. Now, for a lot of the period, yes, a lot of inflationists didn't like the fact that there was monetary growth, but monetary growth was relatively subdued and it was relatively consistent over time. Everything changed in 2008 when we shifted from a strategy of using interest rates to generally guide monetary policy to having no interest rates and therefore using monetary printing, also known as quantitative easing, to drive the monetary policy across the world, essentially. And that, in essence, created an excess supply of capital, money, whichever way you want to look at it. And Bitcoin came out of exactly that moment and addressed that issue to say, okay, what you're going to need is something that holds value over time because it has predictability in its strategy of supply. And digitally, this was a new world because it was distributed and all of the security that comes with that just didn't exist before. Because there's always a nefarious player, whether it's a government who clips the edge of the gold coins or whether it's a central bank that increases the amount of supply of money in the system. So it came out of that whole system, and it seems to be an extraordinarily good solution. And that's just the tip of the iceberg, obviously.
And Lynn, I mean, following up on that, to what extent do the critics who will say, well, look, you know, Bitcoin may be perfectly good, but it doesn't have credible real world use cases, or it doesn't yet, and therefore crypto is always going to kind of sit at a disadvantage to gold as part of a macro investor's portfolio. How do you think about Bitcoin from that point of view versus gold and other precious metal assets?
So I think both gold and Bitcoin still have a role in a portfolio. They have different strengths and weaknesses. But if anything, I would say that Bitcoin has more real world use cases because unlike gold, Bitcoin can be continuously updated and built upon with extra layers. And so what we're seeing, for example, is we're really kind of seeing the Lightning layer start to hit critical mass, which is essentially that we have the second layer protocol, so you can do cheap, nearly instantaneous transactions. And that's one of those things. I mean, that's been a work in progress for a while. The white paper came out in 2015. Then they did some, basically an agreed upon set of specifications in 2016 to make, different companies' implementations of Lightning interoperable. Then the SegWit update to Bitcoin in 2017 really allowed Lightning, as we know it, to start building on top of Bitcoin. But then from there, it took a couple years to build out the tools, build out the liquidity. So if you look at like a channel map from 2018 compared to 2021, it's like night and day. And so as we've kind of built that network out, or as like people like Elizabeth Stark of Lightning Labs, Blockstream's been working on it. There's different implementations of it, but as those developers have built out those tools, I think that's kind of expanded the use case of Bitcoin, as we're starting to see in places like Bitcoin Beach of El Salvador, as was on display a little bit at the Bitcoin conference, this past couple weeks. And so overall, I do think that Bitcoin, ever since around 2018, I think it's become a pretty credible macro asset. It's reached a large enough market capitalization that is kind of on everyone's radar. And then it also settled some of the fork wars back in 2017. And so when you have that combination of a credible, a very difficult to change, underlying protocol and monetary policy, and then you can build other things on top of it, or side chains, or like Lightning secondary layer. That's a really strong network effect to pay attention to, and the network effect is both on the first layer, and then increasingly we're having a network effect happening on the secondary layers as well.
And Raoul, I mean, again, to that point around payments, how much is Bitcoin's ability to scale at the second layer, Lightning Labs being an example, how much is that required for it to continue to defend its position as a macro asset? Is that required, or?
I don't think it is at all. I think Bitcoin has a very unique asset that the rest of the space doesn't have. The rest of the space is basically the applications layer of the new Internet of Value. And Bitcoin is the value, and that's the different thing that it holds. So it actually doesn't need any other applications apart from to be accepted as a store of value and to have network effects for that particular narrative. That's literally all it needs to do. And we'll come on to talk about how that develops over time, because still it's a relatively immature market, because it's still volatile. It doesn't have a yield curve, so there's no time preference within it, stuff like that. But that's all coming. So I don't think it needs any of these other things. The other things are just strengthening the network. As Lynn said, it brings new elements of new networks on top of each other, and that's all well and good. But people are missing the point if they think there needs to be a consumer app. Bitcoin is the app. That's all it needs to be. And we can all use it. Much like gold and jewelry. Jewelry's a red herring, really. Yes, gold jewelry was for a purpose. It meant you were able to store gold yourself and you would wear it. That's basically it. The actual use case is still gold as a store of value, and that's it. And that's okay.
Right. So to quote someone who I've forgotten, it's the process of drilling the gold, taking it out of the ground, melting it into bars, and then putting it back underground. That's its principal use case.
Yeah.
And so this, I think we're sailing very close to what we might call the Feffer thesis. And I really want to discuss this, but maybe the context for this is kind of better when we bring the discussion onto Ethereum. And Lynn, back in January of this year, you circulated a very widely read piece of analysis, long form analysis on Ethereum. And whilst my understanding is that you are an ETH bull, ETH being the obviously the asset sitting at the heart of the Ethereum network, you struck a slightly more cautious tone and themes around sort of likelier malleability of the network versus Bitcoin. Perhaps that means that it's ETH is lent a low degree of stateliness as an asset. It's also its issuance rate, various other things. I wonder whether you could take us through that thesis before we come back to the sort of the John Feffer argument.
Absolutely. And basically, so I separate kind of a tactical price action in an asset like Ethereum in this case, compared to, say, longer term assessments of tail risks or kind of threats to the network effect in a sense. And so basically there's kind of the long term concern and then the near term bullishness. And so the long term concern is essentially the idea that, with Bitcoin as a bear asset, the network effect is about Bitcoin itself, as Raoul I think really well articulated there, and then there's additional use cases on top of it. With some of these smart contract protocols, the challenge is that they're more about doing things, they're more about applications, and so we can see, for example, switching costs between the networks. And so far, Ethereum's the only other protocol besides Bitcoin that's developed a really serious network effect. But we do also see, in its wake, some of these third generation protocols come around. And we see, for example, if you look at, say, Tether used to run on Bitcoin's Omni layer, then it switched over to Ethereum. And then as Ethereum fees started to get pretty high, it started switching over to Tron. And so basically, a lot of these other protocols can come and they can make more centralized applications that are cheaper. And some of these applications have pretty low switching costs and can go over to them. And so I think the big concern is that even if, say, Ethereum takes off in a pretty profound way, it might not result in long-term token accrual in the same way that it most likely will for Bitcoin. Now it could. There's ways that it can happen, but I think there's more of a risk that Ethereum kind of long-term might have a challenge in kind of sustainably capturing a monetary premium, even though it's more of a probability assessment. And then it comes down to, I think the last point is that Bitcoin's monetary policy is pretty credible in the sense that it's very, very hard to change. The nodes are kind of fully in control of that. Kind of a big check on the miners. Whereas Ethereum, I view it in many ways more like an equity. And really, that's kind of most of the space I view more equity-like, in the sense that developers have things like time bombs that can, like difficulty bombs built into the protocol. Basically, developers maintain more kind of control of that network. And so they have more ability to change the monetary policy, more ability to change things. And in addition, the whole, transition towards ETH2 presents opportunities, obviously, but also presents kind of fundamental risks to the protocol at a time when it also has these other competitors.
So I guess there are a couple of questions there I kind of want to ask as follow-up, and maybe one of them to Raoul is one that Lynn mentioned, the mobility of something like Tether, which seems to be able to kind of hop from one system to a next. But how much does a smart contract system like Ethereum actually kind of achieve a level of stickiness, of kind of friction, due to the composability of its smart contracts? In particular, the coordination difficulty of these smart contracts sort of migrating from layer 1 to layer 1.
I think that's a static view of the world. What we think of is, okay, there's Ethereum, we build applications on it, and what happens if they go somewhere? This was the old Bitcoin view, is, oh my God, if Ethereum came, people aren't going to use Bitcoin. It's nonsense. The view that I have is the space is growing at 113% a year. That's the whole crypto space in terms of number of active users. At 113% a year, it's double the rate the internet got adopted between 1990 and 2000. This has been going on now for best part of about 10 years, this kind of network adoption. This is the fastest adoption of any technology in all recorded history. It's faster than the mobile phone, it's faster than the telephone, it's faster than the internet. The space is growing much faster overall than Bitcoin or Ethereum. Once you start developing all of the other use cases, they will find homes to sit on, whether it's one network versus another. And that's okay. It's because the whole thing has network effects. So Bitcoin has a network effect. Ethereum arguably has a faster, stronger network effect right now because there's a lot more action going on with more types of interactions between nodes going on. But then the whole space is seeing the same. And then we've got interoperability layer above it, which connects it all. So yes, things can shift around, but the sheer magnitude of what is about to happen onto the bigger network, let's call that digital asset space, is so big that it makes no difference. And I went and spent some time looking about network effects, and I basically showed that actually the largest single explainer of prices of Bitcoin was exactly the same as that of Ethereum, which was network effects. And it wasn't to do with stock to flow. It wasn't to do with anything else. It wasn't to do with whose monetary policy. It was how active the network is. So I still believe Metcalfe's law is the right way of valuing all of this. And just different protocols have different attributes and will be used for different things. And that will shift and change as things develop. And that's good and healthy, I think.
So could we again? It's slightly returning to the Lightning Labs comment, but when we start to think around the kind of the fundamental velocity of these assets, I mean, I guess one might say the core asset on these networks, whichever it may be, Bitcoin, Ethereum, generally speaking, historically, the analysis has been a low velocity means a high price in very crude terms, the MV equals PQ thing. And I'd love to kind of briefly cover the Feffer thesis. In particular, Raoul, this is something that you brought up on Real Vision a couple of times. How tenable do you think the Feffer thesis has been? If anyone's, by the way, not aware, John Pfeffer's now well-known thesis was an institutional investor's take on crypto assets, published, I believe, around the end of 2017. And he talked about the MV equals PQ equation. Basically, higher velocity means kind of lower tenable price for an asset. And the conclusion he drew at that time was Ether is likely to have kind of higher levels of velocity and is fundamentally is a utility token at heart, and therefore is not necessarily going to be able to catch value in the long run. Raoul, where do you think that that thesis stands now?
Look, I thought it was a very interesting article, and I didn't agree with any of it. Firstly, I hate monetary equations. They don't work, and they never work. So MV equals PQ is firstly a false presumption. It's not applicable in real life. It's always proven not to have been, and it's pretty much been abandoned by most mainstream schools of economics because it hasn't worked. So that I don't like. And then John Pfeffer's argument was basically only Bitcoin can have network effects and nothing else can. So therefore, they should all trend towards utility value or zero or whatever argument you want to take. But again, if we look at how these things are adopting, they're all adopting Metcalfe's law. And John Pfeffer's argument was that only Bitcoin could do that. But the evidence suggests otherwise. Now, we're only at this stage in the game. Who knows how the game plays out, right? There are no certainties, and I could be dead wrong, and maybe this all trends differently. But I don't see evidence of that. I think that most people misunderstand network effects and valuing networks. Everybody misunderstood Amazon. At first, we all said, everyone I knew said, this is ridiculous. It's worth more than every other book ever sold in history and all booksellers added together. It's because it wasn't a book company. It wasn't a bookseller. And we see this time and time again with networks that people underestimate them because they're exponential in nature, and we tend to think linear in nature. And I think I think that the value of the network is going to hold out because we see it as the predominant business model in this digital day and age. And I think it'll apply equally across the space. And it's the easy way to judge what is a good protocol and what isn't. It's just network effects. If not, it's guesswork, and that's okay. That's VC. You know, is this going to succeed or not? Or is it going to get Lindy effects, or is it going to fail on its first S curve? We don't know. But to me, I think the MV equals PQ theory of money doesn't apply to economies, and I don't see why, therefore, it applies to digital assets. And I think we need a better understanding of network effects to truly get to the bottom of what's worth what.
So, I mean, even if a powerful network effect were to kind of contribute to, let's say, Ethereum achieving kind of scale, and whether there are or are not moats around that is TBD. But Lynn, how do you sort of see the transmission mechanism from use of Ethereum as a network into the value of ETH itself? In other words, does there need to be a link between increased use of Ethereum over time and the appreciation of the underlying asset? How do you think that transmission mechanism will play out in terms of your supply sinks and whatever else?
Sure, and I think that's the big part of what we're seeing now with the staking approach. And if you go back to the MV equals PQ equation, so that has been valid. It's just the things that were invalid were the assumptions that some economists made about that calculation. And specifically, they assumed that velocity was pretty constant, but that ended up being what they were very wrong on. And so what happened was that as velocity went down, even though say M rose very quickly, you didn't have P rise very quickly. In other words, you had less inflation than you'd expect based on what happened, because they did not expect the velocity to gradually go down as much as it has over time. And so basically the Feffer argument takes that equation and says that even though he's pretty bullish on the PQ portion of Ethereum, the overall kind of, you could say, GDP that will happen in Ethereum over the next 5-10 years, he has questions about that if velocity goes up, that the M might not go up as quickly as people would think based on that PQ portion of it. So they could be right about PQ, but then they might not be right about M in the same way that economists, assuming velocity was static, ended up being wrong about price inflation. And so I think so far we've seen kind of partial confirmation of that, in the sense that, say, Ethereum's transaction transaction value per year has gone up faster than its price so far. So we have seen that kind of play out, but of course it's still been a big enough effect that price has also gone up. It's just not gone up at quite the same percent rate that say it has from when he wrote that paper in late 2017 to currently. So I still think it's kind of playing out in over time, and we'll have to see kind of where that develops. Now, some of the kind of answers I think in the Ethereum community are to basically monetize Ethereum more, right? So staking is a way to kind of sink some of that velocity. We also see that in the DeFi protocols, Ethereum's used as collateral. And so those are ways to attempt to give Ethereum a monetary premium, while it also has that kind of working capital aspect to it as well. So you kind of have like Ethereum as like oil or copper, but then those staking and those collateral is more like Ethereum is gold. And so if those can take off in a big way, then you can basically have a more persistent value accrual in Ethereum in kind of a similar way to Bitcoin. But then again, you still have to fend off some of the competitors that might want to eat into that market share. Now, in the funny thing is, in the near term, when you have kind of ETH2 staking going on, but ETH2 itself is, kind of in this, we don't know when it's going to launch. It's been somewhat delayed over time. It's a very challenging thing to launch. And so actually it's one of those things where if you have EIP 1559 ready to come into effect, and you have ETH2 staking, while ETH2 itself is kind of delayed, that's actually kind of a perfect storm for price, because you're basically, unliquefying Ethereum. You're basically pulling it off exchanges, locking it up in these ETH2 staking, and then also when you have the deflationary aspect of EIP 1559 come into place, it is pretty hard to be bearish on Ethereum with, say, a 12-month view. I think the bigger concerns are maybe long term about M not going up as quickly as PQ if velocity has that kind of gradual increase.
And I guess part of that, Lynn, is going to be dependent on, so let's say that remains observable, that the network grows faster than the price. But that doesn't matter if the network continues to grow at a ridiculous rate, because price will rise. And it can still be worth more than the Bitcoin ecosystem over time, just by the network effects. So, it's interesting. We'll see how it plays out. As you said, because we don't also know whether more of the financial system gets built on it or it spreads into other protocols or whatever. But I think you're right. I mean, this staking thing is going to be super interesting, because it's a conversation we'll have in a bit. It's starting to get yield curve ways, you lock money out of the financial system, and therefore money is more rare. I mean, it's as simple as that. And that becomes quite interesting. So, this is one of the most fascinating things, all of this going on. And, we don't know where it goes, but I think the probability seems that as long as the network continues to grow, which is network value, then the price will continue to grow. If network doesn't grow and it gets robbed by the other networks, then it changes over time, which I guess is true of every network on Earth.
Yeah, so I guess are we sort of saying, certainly sort of in the context of the Feffer thesis, are we sort of saying the equation isn't broken, but the way that sort of velocity, the amount of uncertainty of what's going to happen to velocity is extreme, and every time that we see a new supply sink, it's sort of altering velocity, so that the sort of it's basically now a matter of semantics, is how we kind of interpret.
Yeah, and I still refute that the formula's ever worked, and people have said, well, it's to do with velocity, but it's never functioned as a mechanism for understanding the world around us necessarily. It sounds right, but its real life applications, I think, haven't been as strong as the Chicago School or anybody else thought it would be. Inflation just is not driven by the factors that people think it is. And to put it in a neat little equation, I just don't think is really what drives things.
And to Lynn's point, I mean, if V moves around all over the place all the time, it certainly is happening kind of structurally, functionally on Ethereum right now with EIP 1559 and the increase in adoption of staking. I guess it becomes. I can see how it comes.
I think there was a more important point that Lynn made that I've been trying to get my head around, and I think it's dead right. I was just thinking that, look, it looks like we're going to get ETH 2.0 by, let's say, March next year. The chances are that there's going to be a massive outflow of staked coins after that. It's going to be a buy the rumor, sell the fact, just as a side, as a price thing. And that's a fascinating, because I was thinking that myself, and I thought, I'm not sure what the mechanism is, but it feels like it's going to be a buy the rumor, sell the fact. But now it feels that a lot of the stake coins will come out. And obviously people are going to take some profits or switch around elsewhere in the digital asset space. So I think that's a really interesting thing.
That's interesting. So you think right now the sort of supernormal return available to kind of early stakers, once that, as that ROI compresses, is that the point at which you see people withdrawing their coins?
No, I think so many people want to stake the network to get this ETH 2.0 across the line, etc. Yeah. We don't know what the staking rewards are going to be in due course. You know, we've got all sorts of kind of forecasts on what it could be. But the point being is, if you staked your ETH for the last year to get this across the line, chances are you might take some off the table. It's just an interesting way of thinking about supply coming onto the market that's currently never coming onto the market. It's not going to come onto the market until ETH 2.0 because people won't get this across the line. So it was just an interesting side view on that price.
We'll watch closely and come back to you in a year's time. So the next thing I wanted to cover is, I don't think it's really been much discussed. It's going to involve a lot of guesswork. Is the notion of yield curves. It's something, longer term yield curves are things that, at least in kind of crypto denomination, we've not seen very much of. There is, I believe, one protocol, yield.is, I think came out of Paradigm and a handful of other people. But it's, you know, really a liquid curve. So functionally, we don't have long term. We have kind of overnight rates working quite well through things like, you know, Aave and MakerDAO and these kind of financing applications. So I kind of wanted to ask you both, and Lynn, maybe starting with you here, is where are these? We've typically priced interest rate markets, credit markets off some sort of risk-free reference curve, and we sort of don't have that handrail right now. Where could it come from? Is it going to come from staking? Is there a risk-free borrower somewhere? How do you see this evolving? Can we sort of start to guess how credit markets might evolve on Ethereum and other networks?
Yeah, I mean, at the moment, like you point out, there's no really risk-free rate at the moment, and so if anything, it's right now it's more like a free banking type of era, in a sense that you have different rates, you have more credible, basically places that have kind of lower rates. Then you have maybe ones that are more speculative, that are less trustworthy with higher rates, and so we see kind of an array of different lending rates out there on both kind of centralized platforms as well as some of the decentralized ones. There has been kind of thought put forth by some thinkers like, say, Nick Bhatia, that he's kind of referenced the Lightning Network on Bitcoin. He thinks that the risk-free rate could develop there for that particular network, because that's one of the ways that yield can be generated without kind of having credit risk. It might be, it's in some ways it's kind of Bitcoin's form of staking, in a sense, where instead of doing proof of stake, you're basically, you have capital on these secondary layers, and so you get routing fees from basically letting people use your liquidity. And so it's interesting because you're not, as long as you're doing it properly, as especially as the network gets more developed and you have watchtowers to defend your active nodes, you're basically approaching zero risk while still generating a low yield if that becomes mature. So that's one area that I'm kind of watching, because that could compete with some of the lending aspects. And then Raoul can probably speak better than I could about some of the other protocols, but essentially when you have very over collateralized loans, again you trend towards lower risk in those, and then you have a spectrum of lending rates compared to how much risk is involved.
That's really interesting. So you actually see that one potential candidate is almost a sort of a technical risk premium, sort of sets some future yield curve. That's super interesting. And I mean, Raoul, I suppose to put maybe sort of the converse question is, could we do away with such curves? Is there a way we can sort of survive without some canonical reference for kind of risk-free borrowing?
I think it's not urgent. I think institutions coming on board will mean that they will want to get some return outside of just price for holding an asset, but you don't really have it for gold, so it's okay. I think it gets interesting when we start to get towards the 21 million number, when there's no new supply. Then it becomes interesting in what you get paid to lend it out to people who want it. And that's usually where the market comes from. Right now, we've got this money market that, as Lynn said, is kind of distributed and is independent actors. So there's so many different variables or different yields that you can get. And the reason being is we don't know what the risks are. So, you can look at either, stable coins with Tether hit sometimes 8% yields. Now, does that make sense or not? Well, a lot of people think there's some risk in Tether. So is 8% the right number? Possibly. But where do you get a risk-free rate? There is no risk-free rate in that number. You've got risk rates, and that's good too, because you get to choose which risk part of the risk curve you want, which you don't now get in the junk bond market, because basically everything's priced to the institutional yields, i.e. they've rammed yields down as they've had to try and attract more yield. So I think it's interesting and good that we've got this anomaly. It's hard for people to navigate because they don't know the risks, but something longer term, I think the institution is going to start driving this. So my guess is somebody like Fidelity will own a bunch of Bitcoin, and they will go to a third party like NYDIG or somebody and say, what are you going to give us to borrow this for the next 3 years, or whatever it may be? So I think we're going to move further out. We won't have anything long term. Gold doesn't really have long term funding markets. So it's not clear, but it's going to be fascinating. But if we want it to be money, it needs to have time value somewhere along the line that is not just price. Because basically, once you get to a much more saturated market of Bitcoin, price doesn't become the main driver. Stability does. So in which case, you're going to have some sort of preference. And maybe we just don't even need it because we assume that the debasement of currency is the yield. Maybe it's that. Maybe it's a different way of looking at the world, that it's already inbuilt in the network value.
Sort of anti-gravity situation. But I see it. So I think the point is, you're making the point really that you've got this chicken and egg problem to solve, because you need price stability for people not to have to be a lunatic to borrow in this denominated in these assets, and vice versa, until people start to borrow in those assets. Actually, you don't have the usual equilibria that keep a currency in a nice kind of steady.
Yeah, I mean, people ask me all the time, "Oh, are you involved in DeFi?" I'm like, "No, it's super interesting, but no, I've got no reason to take a risk on a project of which hasn't gone through a full cycle, so we can't tell, to get a 5% yield when the asset's going up 213% a year. It makes no sense." But I understand that some people do want that, and it's different. I think staking's super interesting way to think about this too. But 70 vol assets don't really need a risk-free rate, as you say.
That's why I think we have to kind of separate into two eras, right? So we're still in the early era of these protocols are exploring their TAM. They're exploring how big they can get, and that's part of why there's so much volatility. Is Bitcoin going to be worth 1 trillion, 5 trillion, 10 trillion? Is it going to basically run into a limit and kind of die out? The market is kind of judging all these different options, and so it's got this really volatile exploration of its TAM. Same thing for some of the other protocols. And so in that era, yield is like, it's more for exploration and research rather than something you need, right? So I do a little bit of yield type things just to explore the ecosystem, but not with any real money. And so we're in that kind of phase now where you just hodl. Essentially, you stake. If it's Ethereum or if you're Bitcoin, you just kind of hodl it, and that's kind of the part we're now. And to Raoul's point about that your yield is fiat debasement, that's essentially what gold does now, in the sense that if you hold gold, you're not generating a yield on your gold. Although ironically, in DeFi, you actually can do a little bit with, say, PAX-G tokens. You can actually get a little bit of yield on your gold. But essentially, in most gold markets, you're not getting yield, but you're just protecting yourself from, say, negative real rates in fiat currencies and basically broad money supply growth over time. and you're kind of just locking that away. And so I think we're in that phase for some of these other protocols, and just in a more exponential way. And then if they were eventually kind of settle out, and we kind of we get closer to the top of how big these assets can get, that's when yield becomes more important.
So Lynn, here's a question for you that I've been trying to think through. Can we have a separate yield curve to the central bank yield curve, or does it just get arbitraged away over time? I mean, I don't see, if you can borrow unlimited money from the central bank and put it into this. I've been trying to get my head around this, thinking, is it even possible? Because unlimited money flows into the higher yield over time, and it collapses. I don't know. What do you think?
So my expectation is it should come down over time. Right now, it's just a very unexplored market, right? So you can get 8% on even non-tether stable coins, even like USDC, which is arguably safer. And I think that eventually gets diminished. But I kind of view that in more of like a high yield type of market, where you're still taking on risk of say you do it on BlockFi, for example, you're still taking on BlockFi's credit risk, their lending capability, the say tail risks of things like fraud or things like that. And so you're transforming a truly nominally risk-free investment into something that can earn a higher yield, but it does have risk. So I think it should kind of eventually approximate, say, high yield markets or utility stocks or something like kind of lower end equities or high yield.
Yeah, I guess what's if you I mean, it's very interesting if you look at quite a lot of these DeFi protocols, and they'll often kind of say that what they're doing is monetary policy, or that they're kind of acting like a central bank. But actually, when you look at then the mechanics of how they work, they look quite like mechanically like a commercial bank. So in other words, there is that kind of credit risk premium on these networks, because they're basically, they've got an asset base which is crypto today, and they've got a borrowing base which looks like a deposit, which may or may not be callable. And that actually kind of brings us on to the last topic, which has got 4 minutes to cover. So I'm sorry we don't have a lot of time to cover it, but there's always this question around regulation. In particular, we've heard some slight noises that we might see capital requirements introduced into the MakerDAOs and the Aves and whatever, but borrowing and lending networks. Is this even possible? How on earth do authorities, they can't enforce KYC or AML at the border of decentralized exchanges. Where can they get access here, and can they start to place capital requirements on these DeFi networks? All
they can own, Tom, is the on-ramps and the off-ramps. They just ban you from using it. So you might not be able to force a DAO to change its construction and its capital requirements, but you'll stop people using it. And, I think that's a battle that's to come. And we don't know how it's going to play out. And, I don't think it'll be a single battle. I think there'll be many points in it, and we'll see how that plays out. But yeah, they will try something.
Yeah, I think there's a spectrum of regulatory risk to be aware of. And so Bitcoin has some degree of regulatory risk, but then I think as you get out into other types of protocols where you're getting into lending markets, and lending is generally a highly regulated market, that's where I think some of those are more vulnerable to other types of actions. And so they can control the on-ramps and off-ramps. They can also, if say the certain protocols have non-anonymous founders and operators, they can go after them legally. There's way they can have, like, say, major cloud providers can't have, say infrastructure like some of these DeFi protocols running on them, depending on how draconian they want to get. And so they do have a lot of levers they can pull if they decide to crack down on some of this. And partially it just comes down to educating the policymakers and having them kind of allow innovation while still trying to make sure there's no major time bomb out there in terms of these huge kind of unregulated markets.
Yeah, it makes sense. I mean, I was thinking the other day, what if Maker were to have a government's proposal tomorrow to make DAI redeemable? Well, now that's a deposit, but it wasn't the creator of the protocol that originally thought that DAI should be redeemable, so it wasn't a deposit when it launched, and can they go after the person who if they can identify them, who pitched the governance vote? Because obviously it's got to be a kind of collective vote by all these people. It seems very difficult. Brilliant. Well, I'm being told that we're sort of up against the clock now, but Raoul, Lynn, thank you so much for your thoughts. I've been very grateful. I think that could have run on at least 2 or 3 times the length, but very grateful to get you both back in the same room again. And I think now I'm handing over to Ian to take us onwards.
Cheers, Tom. Based on the description, I was actually hoping for an answer to the question whether I should buy Dogecoin or Shiba Inu. But jokes aside, that was perhaps the best 40-minute overview of digital asset investing that I've really had the pleasure of listening to, and independent of whether I'm fanboying a little bit over the panelists. Lynn and Raoul, thank you so much, you're legends. Up next, we have the first of our 4 decentralized finance panels, where we'll find out about the empowerment of individuals and protocols to control their assets and economic parameters, and how it's threatening the influence of central banks. This is the Open Web Forum at CogX, curated by Fabric Ventures, and we'll see you back here in 20 minutes.